Nokia's well-cited global network traffic report forecasts that data travelling over wide area networks will potentially grow at 3x on conservative assumptions, but potentially up to 7 times on more aggressive projections in the 10 years to 2034. This represents very strong levels of growth even at the lower end of this range, and the report emphasises how network traffic is being driven by 3 primary forces, with continued domestic data consumption growth likely to become matched, if not outshone, by the growth in enterprise and industrial traffic as robotics, agentic industrial automation, and the always connected operations come fully into force. And of course, AI continuing to fundamentally change the landscape for data traffic and how data is used. Digital infrastructure, often termed the plumbing of the internet, which includes telecom towers, fibre cabling and data centres, are critical in enabling this growth. And today we revisit the topic with the hugely experienced Stephen Marshall from Cordiant Capital, the investment manager of the London-listed Cordiant Digital Infrastructure. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website killik.com. In today's episode, we were delighted to be joined by Stephen Marshall, the founder, executive chairman and managing partner of Cordiant Digital Infrastructure Management, the investment manager of the London-listed and circa 900 million market cap Cordiant Digital Infrastructure, ticker CORD. There are few better and more qualified professionals to speak to when it comes to the management of digital infrastructure assets. Prior to the listing of Cordiant, Stephen held the position of president of the US Towers division of the American Tower Corporation, or AMT, and had a material influence in the making of that company to what is now the largest network-neutral telecoms infrastructure company in the world, with a market cap of nearly $100 billion US. We featured Cordiant back in episode 21 of the Investor Insights series in its first year, in an interview which highlighted some of the key characteristics and the attractions of these infrastructure assets. This week, following the company's move to the main market, we were delighted to find some time with Stephen to delve a little deeper and discuss the portfolio, its prospects, and the impact of some of the very topical factors currently at play. We hope you enjoy the conversation, and as always, please get in touch if you'd like to discuss further or would like any more detail on any of the topics that we discuss. Hi, Stephen. Good morning. Thank you so much for sparing some time for this. How are you doing today?
Great. So, Gordon, how are you?
Yeah, very good. Thank you. Very good. So we've got this kind of standard opening question to these, and we've been asking people just to kind of share an anecdote from a recent meeting or something that they've been working on recently. But I wondered if there's something that you could share. I know it's a particularly kind of poignant day today for Cordiant. Could you share kind of what's been going on this morning?
Well, I guess an unusual day for me, Gordon. Part of the job is obviously running the portfolio, running the fund, but today was something special, in that both the FCA and our shareholders over the last few weeks have actually approved that CDIL, Cordiant Digital Infrastructure Limited, it is appropriate for it to move up to the official list on the main market of the London Stock Exchange. So you will know full well. Of course, we were previously on the specialist fund section of the market, whereas now, as of today, we got the opportunity, the chairman and myself, to ring the bell to open up the market and to announce that we will be now listed on the main market, and we will have eligibility right over the next few weeks when the FTSE 250 committee meets. I would expect that we would be included in the FTSE 250 index. And of course, you'd expect then that would lead to some additional buying, as index funds need to buy the index, of which we'll be part of. So, a fun part of the job this morning doesn't come very often, but very, very, very exciting development for us.
Yeah, no, good moment for them. I'm sure a proud moment for the for the company and you as well. Yeah, it can be very significant getting into the indices, but really brings it onto the radar of the kind of new set of investors. So yeah, a positive moment. I mean, Stephen, we actually recorded a discussion on the Cordiant strategy as part of this series, but kind of way back in 2024. And what that discussion did is it kind of introduced the strategy and some of the kind of key characteristics of digital infrastructure. But I wondered, to kind of set the scene for this discussion, if I could ask you to kind of give a kind of brief summary of the current portfolio. Could I ask you to kind of do a bit of a whistle stop tour of what the portfolio is exposed to, the kind of the different types of holdings, and then we'll kind of move on to go into a bit more detail. Could I ask you to kind of give a brief summary
Yeah,
of
no, of course, Gordon. Cordiant Digital Infrastructure Limited, an investment trust, now listed on the main market of the London Stock Exchange. It was originally listed on the specialist fund section some 5.5 years ago. We raised just short of £800 million to invest in digital infrastructure. And digital infrastructure we define as mobile telecommunication towers, fiber optic networks, and data centers. And these are the real assets, right? These are, physically owning the building that houses, servers for a data center, owning the fiber optic network that you utilize. In fact, what we're utilizing today in order to host this podcast, right? So, and we're connecting over fiber optic networks to a data center that's got a server that's providing the intelligence behind it all, and indeed mobile telecommunication towers, where we get that same level of connectivity on a mobile environment over our mobile telephones. So those three assets we collectively uh, call them digital infrastructure. Internally, we sort of call them the plumbing of the internet. So nobody can actually access the internet or provide these team or Zoom meetings without going over the type of assets that we own in order to make that possible. And when we listed 5.5 years ago, we said that we would invest in these assets in OECD countries, UK, Europe, and North America. So nothing particularly too risky. We said we would invest on the basis of a core plus type strategy, delivering a 9% total return made up of a dividend yield plus some growth in the underlying asset base and net asset value. And we would invest in smaller markets, almost by necessity, because these assets are very expensive. And what we do want is, when we do buy an asset, we want strong brands, strong competitive moat, good management teams, etc. So we have historically invested in smaller markets, and that has served us extremely well over the last 5.5 years.
Yeah. Yeah, thank you for that good summary. I mean, it's clear that the kind of Cordian approach isn't one just of kind of simple, kind of passive ownership of these businesses. You talk a lot. I mean, right from the launch, it's been this idea of buy, build, and grow. And you take I mean, it's often a controlling stake. I think you're on the board of most, if not all, of these businesses. I wondered if I could ask you to maybe run through a case study of that buy, build, and grow, and how it's kind of worked in action for one of the holdings, perhaps.
Well, absolutely, you're right, Gordon. And just before I do that, let me just remind your listeners that, I'm not a banker, I'm not a financier, and I spent all my life as running, bigger and bigger companies for multinationals, and I spent the last 25 years really running digital infrastructure type businesses. The last one being the president of American Towers, US business. American Tower is the biggest owner of telecommunication towers in the world. It's listed on the New York Stock Exchange, and today's probably got a market cap of around about 90 billion dollars. So a pretty significant business. Um, so the investment trust that we have also, I think, reflects sort of my history and my background, because we are staffed with probably 50% of investment analysts, bankers. We're staffed by bankers and investment portfolios, about 50% of our staff, but 50% of our staff come from industry and have actually been involved in running various digital infrastructure assets. So that's sort of important. The investment trust is permanent capital. We don't have to give it back like normal private equity, sort of raise money from LPs and then they have to give it back to their LPs 5 or 6 years later, which actually does fundamentally constrain the way that they can operate those businesses. You buy a business, maybe you invest in years 1 and 2, and then years 3 and 4 you sort of not wanting to put money out there, and then years 5 you want to try and sell it and get your money back and dress it up for sale, which is not the best way of running a business for maximum value in reality. So we don't have to do that. And we own every one of our assets 100%, with the exception of DCU in Belgium, which is a data center business. We co-own that with Tink, but we are seen to be the digital specialist, and I chair the board, as I chair the board of every other business that we 100% own. And the CEOs report to me, and I work with them in order to try and develop the business, and to avoid minefields that you might come across over a period of time. So your specific question, buy, build, and grow, which is a strategy that has served us very, very well over the last 5.5 years. What does it mean? Well, it certainly means buy good quality assets, right? Buy assets in these middle markets, buy significant assets with a good competitive moat. So we're number one in the Czech Republic, we're number one in Poland, we're number one in data centers in Belgium, and we are number two against the incumbent in fiber optic networks in Ireland. So very, very strong businesses, national champions in many respects, strong management teams, and good competitive moats, which drives good growth and profitability. So that's buy, and then build. Because we're permanent capital, as I've just pointed out, we actually encourage our management teams to look out for opportunities to further expand the physical assets and the networks that they own. So a good example of that would be Emitel in Poland. Owns 750 mobile telecommunication towers. Do you get the opportunity to build more telecommunication towers for the mobile operators? And yes, of course they do. And they've just won a contract with Orange to build out, I think, 230 new mobile telecommunication towers over the next sort of 2 to 3 years. So that's sort of the grow element of it. Expand the business, expand the asset base that we already own. So in that case, building more mobile telecommunication towers. In Ireland, where we own fiber, it's run more fiber out to more enterprise customers, to business parks, to government premises, etc. Further expanding the network. And in data centers, of course, it's expanding the existing bricks and mortars, make the data center bigger, or buying adjacent land and building an additional building in order to expand on that. So you've got the buy, you've got the build, right? And then you've got the grow, and grow is important as well for us, because a number of alternative infrastructure trusts, they might build something and sell the whole capacity. A wind farm, for example, you build it out, you've got an offtake agreement, you sell the whole capacity, Maybe the wind blows a bit faster, it blows a bit less, but all the capacity goes out, and pretty much you've got a fairly stable revenue stream. In all of our assets, we have plenty of spare capacity, and that means we can put more customers onto a tower. We can put more customers onto our fiber optic networks. We've still got capacity in our data centers, so we can bring more customers in. So there's a from day one, yes, we get it. We have a certain revenues, we have a certain EBITDA and cash flows, but day two, those cash flows can grow with new customers. Those cash flows can grow because existing customers want more space on a tower, or more space in a data center, or more capacity on a fiber network. So one of the beauties of this particular asset class is that we have primarily blue chip customers. They want to access our assets for long term. A mobile operator will probably sign a 10-year lease with 4 or 5 year renewals. That could be 30 years term. And because they want that long-term access, of course, we want protection against inflation, so we have escalation clauses, and then we can obviously get more and more customers, I've said, on those assets. So that particular characteristic drives a very predictable, growing income stream profitability over a long period of time, and makes these assets very, very attractive from an investment perspective.
Yeah, you can certainly see how that all feeds into the potential return profile. Yeah, thank you for that. Stephen, I wondered if we could move on to talk about energy costs. It's obviously very topical at the moment. I mean, given the kind of oil price and what that's done, but power strategy has been critical for most, if not all, areas of digital infrastructure well before the events of in the Middle East. I wondered if I could ask you to discuss some of the ways your team and indeed obviously the underlying businesses have approached the challenges of sourcing, contracting power, as well as kind of managing hedging risks for that kind of variable input of power costs.
Absolutely. For a number of our businesses, power is a very significant cost, right, to the businesses. So you can expect us to think very carefully about how we actually manage that. And what a number of the businesses do is they will actually buy forward, the power requirements well in advance. So, for example, CRA and Emitel have bought forward all the power requirements for 2026. Probably half of the power requirements for 2027, and maybe even a quarter of the power requirements for 2028. So that gives us a degree of certainty in terms of that particular cost element. But also in a volatile market, I mean, like today, again, because of geopolitical issues in the Middle East, we're seeing that cost of power is going up, going quite significantly. Now that's quite an interesting dynamic for us, because that won't increase the cost of power for us, because we've obviously hedged, we bought our power forward for 2026. But the cost of that power will clearly, fall into the inflationary indexes in the various geographies, and as a result, that will fall into the escalation clauses under the contracts that we have with our customers. So that will actually drive up our revenues, right, as a result of those increased in those inflation rates as a result of the increase in cost of power. But in reality, our costs will not have gone up for this particular year. Now, if it continues for multiple years, of course, yes, it will eventually catch up, and we won't have an arbitrage. But at the moment, um, uh, somewhat surprisingly, the troubles in the Middle East and the increases in cost of power will actually likely drive improved profitability of our businesses.
Yeah, interesting. Yeah, thank you. Steve, I wonder if you could, again, jumping about a bit here, but move on to kind of valuations, both the kind of valuations implied by the core share prices, but also kind of underlying net asset value. I know you've been frustrated by the kind of persistent discount to which the core shares have traded. could I ask you to maybe summarize some of the valuation metrics of the underlying portfolio and the kind of methodology used there, and maybe put those in context with some recent transactions that we've seen in this space and listed company valuations as well?
Yes, absolutely. Myself, my colleagues, and our independent board have been very frustrated over the last few years in terms of the lack of ability of the stock market to reward the exceptional performance of the underlying asset portfolio that we have. Uh, I guess uh, resulting in a big discount, right, to NAV, right? Our market cap being at a substantial discount to NAV. It's nice to see actually that over the last few days that the share price has taken a step up and is moving a little bit closer to NAV as a result of probably our move onto the main market. But we uh, we uh, we continue to look at how we can sort of try and shrink that discount because I mean we certainly feel that the NAV is it's fairly conservatively computed anyway. Um, and that comes across very much in sort of the I guess the crux of your question, Gordon. Why do we feel it's conservative anyway? It's conservative because our external valuers value the business on the basis of a discounted cash flow, um, and uh, and in reality, some of these assets actually are valued at much higher values than that on a read across basis. So if you look at mobile telecommunication towers, for example, they're the public tower companies are trading at sort of 20 times, 22 times EBITDA multiple. Private tower companies are being sold at potentially even higher than that in the States, sometimes in Europe as well. The same with data centers. Data centers tend to be valued in the mid 20s to high 20s. And fiber optic networks are probably, if you go back, there aren't that many examples, but if you go back, far enough, we saw Zayo trade and go private at about 13 times. Now, we bought most of our assets at somewhere between 8 and 10 times. If you buy Cordiant Digital Infrastructure Limited today on the marketplace, you're probably buying it at about 10.5 times EBITDA multiple. And we have a number of these. A lot of our revenues come from mobile telecommunication towers, come from uh, um, data centers. And I guess if we were to sell those off, we would be getting the sort of the 20 to 25 times EBITDA multiple. So it's quite interesting. There's a couple of very substantial research documents out there. One by Deutsche Numis, another one by Investec, that have actually looked at the our segmentation and where our revenues are coming from, and have actually done a sum of the parts evaluation. And far be it from being, and NAV is 140p. They've been coming up with some of the parts valuations anywhere between a low of 157p and up to a high of 200p. And in fact, our current NAV, is now sort of 4 or 5 months out of date anyway. So we'd expect to see further growth coming out of that as and when we publish our annual report and accounts. So a conservative NAV and still at a discount to NAV, although we've made a little bit of progress over the last few weeks.
Yeah, thank you. That puts it in context. And Stephen, my next question was going to talk about broadcast infrastructure, and I know the company's got some exposure there through the likes of CRA and Emitel, and in recent presentations that you've made and the Capital Markets Day as well, you kind of laid out the outlook and rationale for owning some of those assets against. I know you're often asked about kind of new technology and changing consumer preferences. I know it's a question that you get asked quite frequently, but I wondered if you could kind of summarize your thoughts there just for this audience, if I may.
Yeah, broadcast infrastructure, I think, is a fantastic asset class. Some people feel that it will be overcome by streaming. I don't actually believe that. I don't agree with that. We have long-term contracts with broadcasters in Poland, the Czech Republic. There is continued demand for our assets for many, many years to come. But if you take a step back and you look at some of the other markets, the reality is that deliver broadcast is the most cost-effective way of delivering large quantities of video content, whether it be live or it be film or non-live video. Then it's the most cost-effective way of delivering that. If you were to turn off broadcast transmission and everything was to be streamed, the cost of that would be enormous. The number of additional, computers and servers you would need in data centers would be enormous. The amount of power that you would need to run those servers and to run and light the fiber optic network to deliver all of those individual streams would be enormous. Um, and in addition to that, the environmental impact, the green credentials would be very, very significant. If you there's a large broadcast tower just outside London called Crystal Palace, and it broadcasts live football. It broadcasts, of course, all of the series and films that people watch to 7 or 8 million households. When you turn that off tomorrow, those 7 or 8 million households, maybe even more than one person in each household in different rooms will have to stream, every live football match, every series that they want to watch. It's absolutely enormous. So one signal to 8 million homes against 8+ million individual downloads, for hours a day is absolutely enormous. So I think regulators, governments, even the wider industry stakeholders will ultimately recognize that broadcast has a very, very long-term part to play in an efficient ecosystem to serve wider customer needs. And then there's also a really exciting development at the moment called 5G broadcast, which we've been testing and trialing in Poland, the Czech Republic, about 26 others across Europe and other parts of the world. Other broadcast infrastructure companies are also testing it as well. And what effectively this would achieve is we'd be able to broadcast not to aerials on people's homes, but we would broadcast to anything with a 5G chip in. So you'd be able to receive broadcast content on your mobile phone, on your laptop, potentially on your TV screen if it had a 5G chip in. And whilst that would create even greater advertising opportunity for broadcasters, but also governments are getting very, very interested in this development because at the moment emergency services and catastrophic events, they can actually be governments and emergency services can actually, send out signals across the mobile network to you, a terrorist attack, and you might hear it on your mobile phone. But if you get certain environmental issues, like the flooding in Spain, for example, last year, all of the mobile base stations at the bottom of telecommunication towers got flooded. They all went down, and therefore the people actually in the emergency area didn't actually get the messages. Whereas all the broadcast towers, were still active. Okay, so you could get a message over your TV, but actually with 5G broadcast now, we would be broadcasting that same emergency signal, a message to handsets. So governments are getting very, very interested in the whole notion of supporting 5G broadcast. And I can tell you today that in Italy, the Italian government have actually legislated that Rai have to provide this service in a number of provincial cities, even today. Estonia looking to legislate to insist that 5G broadcast for emergency services should be rolled out because of the threat on their eastern border. So we're already starting to see the early signs of governments recognizing the benefit of 5G broadcast, and supporting those developments.
Yeah, and there's some really important points in there. Yeah, thank you for laying that out. We've got this standard final question as well to these, and it just asks the speaker to highlight kind of one particular area of their investment universe that they're kind of particularly positive on and kind of high conviction on. I wondered if there was a particular area or even just a kind of an upcoming project that you could kind of talk us through.
Yeah, and maybe a lot of your listeners will be aware of it because it's we've flagged it previously. But we are now at the stage of being able to let a contract to build a 26 megawatt data center in the suburbs of Prague in the Czech Republic. We have a piece of land, used to be an old AM radio site. We decommissioned the AM radio well over a year ago. We went to the various government authorities to rezone the site to be able to build a data center, to get all the building permits that were necessary, environmental permits necessary to be able to build a 26 megawatt facility. We already have a substation on site because it serviced the AM radio. We already had fiber running into the site again to service the radio. So we have a brownfield site here, which we've cleared the site. We've built in the services, and we're just about to let primary contracts to build 26 megawatt facility of the the core and the first data hall. So that's quite exciting. This is an investment. Typically these sort of things would cost around about sort of 200 to 250 million, pounds. That's a massive development, an exciting development for CRA in the Czech Republic. When you think about 5 years ago, we didn't pay that much more to buy CRA, and now they're building a 250 million euro or pound data center, and that in due course will be valued in line with data center assets. Probably something like 20 to 25 times EBITDA. So really a fantastic opportunity for further value creation, over the next I would say 3 to 5 years.
Yeah, another good example of the build and grow philosophy as well. Yeah, and Stephen, as always, really interesting to chat to you. I really appreciate you giving up your time. Thank you so much.
Thank you, Gordon, and thank you very much to all of those that invest in us. Obviously, we can't do it without you, but my whole motivation for setting this up was to actually give people access to what is a really fantastic asset class, and which has got great growth potential and hopefully should deliver good returns for individual investors.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.